He's managing director at ClearView Energy Partners. Kevin, I mean, astonishing, dramatic. What is going on with the price action today? What is it telling you?
Well, I think it may be getting a little ahead of the fundamental and real world. But look, this is a world where you're saying it's 98 and it's low. We finished last year at an average of 70, 71. So we have to ask what is normal, what is really going on. We're early still in the Russia sanctions clampdown on supply. We're seeing some demand responses in the Western world from high prices at the pump, but yes, also on store shelves and everywhere else. That's having a cumulative effect. And now all this talk of recession, it's a 93% correlation between GDP and global oil demand. It's not too hard to figure out what the market's thinking.
So it has to be a GDP story, in other words. If we are able to move past this and feel a little more constructive on the economy, we snap right back, I guess. But this trade has demoralized the one part of the market that was working all year. And the only beneficiary from it should be, OK, fine, energy's resetting. It's lower, but everything else is benefiting. But no, it's just nothing's working except for the certain pockets Dom mentioned today.
Well, if we're looking at the liquid side of the oil and gas story, that's right. If we're looking at the European gas benchmark, it's a different story entirely. Look, we're talking about a serious shortage in the world. We're already hundreds of millions of barrels, 200 or 300 million barrels below the 5-year average of OECD inventory stocks. And now we're talking about crowding out 5% of the energy the world consumes, Russia's exports of oil, gas, and coal with sanctions. They don't all hit the barrel, right? But we're already looking at somewhere less, a little bit less than 1% of the world's energy consumption being forced off the market already or soon by sanctions. That tightness is going to come home to roost. So the question will be, what does the supply story look like? Does it disappoint to the downside? If so, I think we might start to see some more appreciation in crude prices.
Right. I mean, none of the fundamentals, I don't think, have changed over the past couple of weeks. Yes, the president has this big Saudi meeting, this trip next week. Could that be partly what's behind the price declines here, this anticipation that more crude is coming onto global markets?
Well, it's a big open question how that'll play out in OPEC Plus. But it goes back to the more real question of where the barrels come from. I think that right now, with the president saying he's not going to ask directly, and with the crown prince probably looking for some sign of enduring long-term comradeship, if not outright friendship, it may be too early to assume we're getting a surplus out of that meeting. But the kingdom can deliver. The rest of OPEC Plus cannot. And so the question, again, comes back to where the shortages show up in the market elsewhere. We just came back from Ecuador. We're moving into Norway. These are in the hundreds of thousands of barrels per day, but they're not nothing.
So I'm almost wondering if energy is going to end up being a self-correcting mechanism for the U.S. economy here, because if, our friend Patrick Tahan of Gas Buddy is tweeting that with oil below $100, gasoline prices could fall almost 50 cents a gallon in the next couple of weeks. That would be a huge boon to the consumer at exactly the point that they need it. I wonder if it could literally help improve attitudes and spending enough to change the trajectory of the recession that so many people are worried about and help avoid that outcome.
It would be a big thing for it to do that, because if you look at the share of the gasoline occupies in spending, we're usually in the 4 to 6% range writ large. And right now we're looking at gasoline as a share of disposable personal income. We're talking about 3.35% trajectory for July right now, coming off of 3.41% in June. These numbers may not seem very high, but they're very high relative to where things were a year ago, year and a half ago. And also disposable personal income itself on a real basis falling because of inflation. So I'm not sure how much relief we're really going to see from 50 cent downtick at the pump, given the broader picture of the consumer. Not to be a pessimist.
All right, fine. Have it that way. Kevin, thank you very much. We appreciate it. We'll check back in soon. Kevin Book with ClearView Energy Partners.